Today, a lot of investors have started investing in mutual funds, but majority of them do not really know how to review their funds. And even if you see signs of underperformance, it creates confusion. Should you continue investing, pause further investment, or sell them completely? That's why in this video, I want to discuss 3 mutual funds that were once very popular and attracted a lot of capital, but now they are underperforming. I'll also tell you how to determine if a fund is underperforming and what to do with these funds. Usually people make the mistake of checking fund performance on the basis of last 1 to 2 years of returns, but that's not the right way to evaluate mutual funds. Then what is the right way? Let's figure out. So when we say a mutual fund is underperforming, what do we really mean? See, every mutual fund is judged against 2 things: its benchmark index and its category peers. So if you take a large cap fund, the benchmark could be Nifty 100 or Sensex. Likewise for mid cap, the benchmark is Nifty Mid Cap 150 and so on. Now let's say during a bull run, the fund delivers say 16% return in a year, but the benchmark did 20%. Then clearly the fund has underperformed. At the same time, during bear market, the fund may generate only 5% return in a year, but if the benchmark has generated say 2% return, then the fund has outperformed. So always try to look at the mutual fund performance in comparison with the benchmark or peers from the same category. Funds return in isolation does not make any sense. But here is the tricky part. Just looking at 1 year or 3 year point-to-point return can be very misleading because it completely depends on the start and end date you pick. For example, if the market crashed last year and bounced back this year, depending on which date you choose, the same fund can look either like a superstar or a complete failure. So instead, you should look at rolling returns. Now what is rolling return? So suppose you invested in a fund on 1st January 2022 and held it till 1st January 2025. That's a 3-year return. Let's say the fund gave you 12% CAGR in that period. Now instead of stopping there, imagine you also check the return if you had invested on 1st Feb 2022 and held it till 1st Feb 2025. Then again from 1st March 2022 to 1st March 2025 and so on. So if you keep doing this for every single date over the last 10 years, you will get hundreds of 3-year return numbers. That's what we call rolling return and tells the real unbiased story. A lot of platform provides you only with point-to-point returns, and that's what investors end up looking at. But if you want to calculate rolling return on your own, you can visit AMFI website and fetch the NAV. But then doing the same thing for the index and then comparing it is a big hassle. That's where I've recently started using this app PowerUp Money, our partner in today's video, which gives the rolling return of each fund. So you don't have to do it manually. Now let's try to understand why mutual funds can underperform. Let's first be very clear. There is no perfect strategy in mutual funds. Every fund follows a certain investment style. Some are momentum driven, where they chase stocks that are already doing well. Some are value oriented, where they look for beaten down companies that might recover. Now the problem is, each of these strategies work in some market cycles and fails in others. For example, when the market is in a crazy bull run, momentum funds outperform and value funds usually lag behind. On the other hand, when markets crash and then recover, momentum funds often get caught on the wrong side. Then comes the portfolio structure. Some funds are highly concentrated where they hold maybe 20-25 stocks. If even 2-3 picks go wrong here, performance takes a big hit. Otherwise, whereas some mutual funds are highly diversified with 60-70 stock, it reduces the risk but the returns also get diluted. So underperformance does not always mean the fund manager has lost skill. Sometimes it's just the style is out of favor, or the fund has grown too big, or the portfolio structure is not clicking in that market cycle. All of these factors lead to underperformance. So it's very important to understand a fund and rebalance when the strategy is not performing or they are unable to adjust to the current market scenarios. And no, rebalancing does not mean your compounding will break. I'll explain this in detail later. Now let us discuss the 3 popular mutual funds that have been underperforming for a while. First mutual fund in the list is SBI Small Cap Fund. It has been one of the most popular mutual funds within the small cap category with an AUM of more than 35,000 crore. Let's see the fund's rolling return. So in last 1 year, this fund has generated a 21.5% rolling return. By the way, the observation period is 5 years, but the category average is 25.7%. Likewise, in 3 years as well as 5 years, this fund has underperformed the category average. If we compare it with benchmark, which is Nifty Small Cap 250 Index, SBI Small Cap has underperformed the benchmark in 1 year and 3 year rolling period. Although it has outperformed the benchmark in 5 year rolling period. Now, one of the reasons for its underperformance is defensive style. This fund avoids taking extreme bets. It prefers quality and stability over chasing short-term rallies. But in the last 2 years, the market has rewarded momentum sectors like PSU, defense, capital goods, manufacturing. Then second reason is curse of size. SBI Small Cap has become a more than 35,000 crore giant. And that's a problem in small cap investing. Many small cap companies trade for very low volume. For such a large fund, it's hard to buy or sell without moving stock prices. To manage this, the fund diversifies across 60-70 names and keeps cash buffer of nearly 5 to 9%. This makes the portfolio safer but also less aggressive compared to peers. So on PowerUp Money app, they also review each fund monthly and tell you if it is performing well or not in a very simple way. Basically, there are 4 bifurcations. First is inform, which means great performance where you can continue investing. Next is you're on track, which is okay performance but you can continue investing. Then third is off track, where you don't need to invest further. And fourth is out of form, which is poor performance and you should exit. Now let's check what this app has to say about SBI Small Cap Fund. So they have marked this fund out of form and it needs to be exited. Exactly what analysis we did for the fund. It further shows the portfolio breakdown in terms of allocation between equity, debt and others. Then it further shows the distribution across sectors. Now if you look at SBI Small Cap Fund performance, it is showing 21 out of 24 rank. You can also see the ranking trend for each month over 6 month, 1 year and 2 year period. Then you can see the fund scorecard across 3 key parameters. Your consistency score that shows how consistently the fund has delivered high return. Next is recency score that shows fund recent momentum and trend. And third is your volatility score that shows how steady or volatile fund returns have been with respect to the market. I'm able to see these ranks because I have PowerUp Elite membership. With Elite, you get Power Rank to select the best fund. Then you can access Rank Trend that gives you bird's eye view of how the ranking has shifted in past 2 years. Then most important feature is rebalancing. Now let's say you decide to exit the fund. The big question comes up is where will you invest that money? What about compounding and many more? For this I'll explain rebalancing later in the video. Now let's look at second underperforming mutual fund. Second popular mutual fund with underperformance is Quant Small Cap Fund. This mutual fund has become extremely popular post-COVID. The reason is because unlike traditional mutual funds that stick to buy and hold strategies, Quant follow a very different approach. They run their portfolio on a quant plus momentum based model. Basically, they don't marry any stock. If the data says buy, they buy. If the data says sell, they sell. Simple. That also means their portfolio churn is very high compared to peers. And this style really made them shine during COVID rally. During 2020 to 22 period, small caps were on fire. Retail participation was at its peak, liquidity was abundant, and cyclical themes like PSU, capital goods and defense were rallying hard. Quant Small Cap caught these trends early and rode them aggressively. While other fund managers were being cautious, Quant went all in on momentum. As a result, Quant Small Cap delivered outstanding results and became extremely popular. In fact, its AUM exploded from just a few thousand crores pre-COVID to 30,000 crore today. That's massive. But here's the catch. The same strategy that worked so well back then is now hurting the fund. Over the last 1 year, Quant Small Cap has actually underperformed its benchmark and category average. The reason is because the market cycle has changed. Small caps are facing valuation concern, profit booking, and constant supply pressure from new IPOs and promoter selling. In this kind of choppy environment, a high churn momentum strategy gets stuck. You end up buying stocks that look strong, but then they fall just as quickly. And with AUM now so large, the fund cannot be as nimble as it was earlier. Interestingly, when I was looking at Quant Small Cap on PowerUp Money, it is ranked 11th. So neither on top nor on bottom, and is showing on track. Although the rank has fallen in last 1 year, still it is not out of form. Also on rolling return, this Quant Small Cap has generated higher return than category average across time frame and also done much better than the benchmark. So PowerUp is not suggesting to exit this fund right now, which I agree with. We should probably watch this fund for some more time. Now let's look at the third underperforming fund. So the third popular but underperforming fund is Axis Large Cap Fund. This fund has an AUM of more than 33,000 crore. For a long time, Axis Mutual Fund was considered one of the best in the large cap category. It's because Axis preferred sticking to high quality, predictable companies like private banks, consumer names and large IT firms. This worked beautifully in 2017 to 20 phase when growth was scarce and investors rewarded quality heavy portfolio. Axis Fund delivered stellar risk adjusted return and money poured in. However, over the last 3 years, Axis Large Cap has underperformed both its benchmark and category peer. First reason was overexposure to quality stocks. Axis funds have stayed heavily tilted towards quality names like SDFC Bank, ICICI, Kotak, Infosys, Asian Paint. These stocks did well earlier, but recently the market has rewarded PSUs, capital goods, manufacturing and momentum sectors, the areas where Axis has been underweight in. Then second reason is Axis follows a relatively buy and hold approach compared to peers. In a fast changing environment, this rigidity has hurt performance. Post-COVID, other large cap funds actively increased weight in PSUs, defense and cyclicals. But Axis stuck to quality heavy portfolios, which are good for downside protection but don't shine in liquidity driven rallies. So Axis Large Cap has not suddenly become bad. It's just that its style is out of sync with the current market cycle. When the market rewards momentum and cyclical sector, a quality heavy low churn portfolio will naturally lag. Now PowerUp Money has ranked Axis Large Cap 24 out of 30 with out of form and exit now call. Fund has been consistently ranked one of the lowest across time frames and its rolling return is also very low as compared to category average as well as benchmark. Well, here is the big question. What should you do next? Please note that no mutual fund will outperform in every cycle. Some strategies shine in bull market, some protect better in corrections. As investors, our job is not to predict every cycle, but to make sure our portfolio is balanced and aligned with our goals. If we stay invested in an underperforming fund for too long, that's just hurting our returns. And the chances of a comeback are very low. I would not suggest taking those odds. Now let me talk about rebalancing here. People think that rebalancing breaks compounding, but that's a myth. Rebalancing does not mean you keep on buying and selling mutual fund units, but monitor your portfolio and only if the upside of switching to another fund is very high, rebalance that fund. It's mostly done manually, but PowerUp has introduced a rebalancing feature in their elite membership and I really think it's a win for retail investors. I understood more about rebalancing from PowerUp team and they explained that they only recommend a switch when your funds and a top rank fund's difference in return is over 5% for 9 consecutive months. Plus, they don't recommend a switch if short-term capital gain is applicable on withdrawal. They calculate the long-term capital gain plus exit loads you would have to pay and only if the benefit of switching is greater than these costs, they would recommend a switch. I like the fact that the reason for rebalancing is shared in detail so investors don't have to follow it blindly. Rebalancing, when done right, can unlock more growth for your portfolio. So I think that PowerUp Money is a great platform to keep a close eye on your mutual fund portfolio for free and their elite plan is a great deal for the value addition they provide in terms of detailed ranking, scores and their rebalancing strategy. It helps you track your funds, spot consistent underperformer and even suggest when and how to rebalance your portfolio. Instead of reacting emotionally when you see short-term underperformance, you get data-backed insight to make smarter decisions. Because at the end of the day, wealth creation is not about chasing the hottest fund. It's about staying invested in the right mix of funds with conviction. So that's it from my side. If you find this video useful, do share it within your circle. Also let me know if you have any doubts. I'll see you next video. Till then, take care.